Welcome back to Fast Market. I'm Tom White along with my co-host Kevin Hinks, but let's bring in our next guest for our hashtag segment, and that's going to be Megan Brantley, Vice President of Research at LikeFolio. Welcome back to the show, Megan.
Thanks for having me, guys.
All right, so we're talking CarMax. This is the largest used car dealer in the country. We've seen the stock pull back pretty significantly. It seemed like everybody was trying to buy used cars in 2021. That's been tailing off according to a lot of the data. What are you seeing on the consumer side as far as LikeFolio's numbers?
Yeah, I think that a macro picture is a great place to jump in whenever we look at CarMax, because we see an interesting scenario. You've got rising interest rates and consumers are aware of this. The mentions from people who are talking about rising interest rates are up by over 500% year over year. So this is top of mind. You've also got, or we've got indications that consumers are starting to feel that burn. So mentions of people who are talking about falling behind on payments, whether that be auto, whether that be home, just different, whether that be credit card payments, these types of mentions are up by more than 100% year over year. So you're starting to see that economic strain actually translate to real pain on the consumers. And one area too, whenever we look at used car sales specifically, so just across the board, there's a serious weakness this fall. So we track these big macro trends. So this isn't company specific data. These are just mentions from consumers who are talking about purchasing a used vehicle. And you can see on the very far right of that chart, that's a pretty steep drop off. Now that we're pacing, 9% lower year over year. So our data certainly matches what you guys are looking at. And just in general, we think this is kind of a warning sign, especially if you are a name like CarMax or other names in this field, that there is a significant weakness here. And really what this chart is measuring is the month of September. That's kind of that time frame there. So that's just a little bit alarming. And really then you dive in further. So, after we look at just the used car macro scenario, how does CarMax look specifically? And we see a similar pattern. In the quarter that they're about to report, so that first quarter, we have demand weakening by about 5% year over year. And, these are mentions from consumers who are talking about actually purchasing a vehicle. So think about actual unit sales and, we would expect some year over year weakness. However, look at that current quarter that's down by about 25% year over year. That's a huge drop, and that's actually a more significant drop than the overall trend. So when you see a macro headwind like a drop off in used car sales, and then you see actual mentions in the month of September for CarMax start to tail off, we think that that could be not a great sign, especially for guidance on this report.
Megan, we're waiting for their earnings to come out tomorrow morning, and I have this sinking feeling that the airbags are going to go off the minute they announce their earnings. This is going to be a disaster. And my question is, how did they mess this up? How did they not absolutely kill it during an environment where you had low interest rates and basically no new cars able to be sold? How did you not have the greatest period in the history of this company? And now you've got higher inflation, now you've got higher interest rates, now you've got people hesitating on big ticket purchases if we go to a recession. How did they not kill it and be riding that wave till now? I can understand why it's weak now, but how did they not do better when this economy was doing so better, guiding towards used cars?
I know. I think that, hindsight's 2020, and looking back, I'm sure that they wish that they, would have planned better for the surging demand that they would receive immediately following COVID, especially at a time during low rates. But now we're here. And now we definitely see in our data just a softening from a consumer perspective. I think another thing that CarMax, failed to do is leverage this unique positioning that it has. Because if you look at CarMax versus competitors, it's kind of sitting in a sweet spot because it has this online model that it built out that consumers were, keen to, especially during the pandemic. But then it also has an actual physical presence where consumers can go in and you can actually look at the cars and test drive cars. Consumers want to do that as well. So it had this ideal positioning. But then whenever you look at it versus peers, you see it trailing not only in consumer demand growth, it's on that left side of the chart. So this is indicating that, those actual mentions from consumers talking about buying, those are dropping, but it's also lower when it comes to overall happiness levels. So whenever you listen to consumers, their overall experience with CarMax versus other names like a Carvana, like an AutoNation, it's a lesser experience, at least be as reported by the consumer. So in our world, you would want to be in the top right of that chart, which is actually where we see AutoNation, but CarMax is in the bottom left. So this is another kind of, I guess, a dreary precursor to this earnings event coming up.
Yeah, and Megan, to Kevin's point in his question, how they messed it up. Well, this stock hit all-time highs over the last year, and there were no supply of cars. I mean, they were trying to purchase cars. There weren't any available due to the demand. But when you look at that scatter plot chart, I kind of wanted to focus on that a little bit. The AutoNation's in the upper right, which is where you want to be. Carvana, who is struggling to stay afloat at this point with their vending machine car sales towers that they have in the suburbs. They're struggling right now as far as their debt load and in rising interest rate environment. That's not good. But to see CarMax, the biggest one in the country, down that far, has that been a reversal from previous metric or data that you guys have had on CarMax? Because that seems to keep sliding.
Yeah, at one point, I think maybe a year ago, we were actually pretty bullish on CarMax. We saw, sales increasing. We saw consumers really excited, especially as things reopened, that they could go out and actually, test drive vehicles again. And they were increasingly turning to a name like a CarMax with that physical location versus a name like Carvana. But in the past, I think 2 years, I looked and sentiment has dropped by about 7 points. And so from a long-term perspective, whenever we're looking at a company, that's a little bit troubling because we were seeing improvements. We were seeing CarMax starting to gain some momentum. And now there's kind of been a reversal in those roles that, sentiment has slid a little bit. And really a lot of it just comes down to consumers, for at least in the mentions that we're looking at, aren't finding the types of cars that they're looking for. So I think that maybe what CarMax has available, that seems to be what's weighing the most on sentiment, at least in our qualitative review. But long term, that happiness indicator, so that customer service and the overall experience that you get, that tends to be a really long term indicator in our world. So it's not good to see sentiment slide by about 7 points. I think now it's hovering around 55% positive, which is pretty low even in the retail space.
Yeah, definitely low just from your historical data. Going into earnings, you guys have a score on this name ahead of the report?
Yeah, so heading into earnings, our score is a -13, which in our world, anything plus or minus 20 is technically neutral. But I will say that if you look at the trajectory of how this earnings score has developed over time, it's trending down. So if anything, we're neutral because we think the current quarter may be decent, just from our data, but we think guidance may be the real kicker here, especially as our data kind of degrades in the month of September. So cautious, neutral, and if anything, a cautiously bearish lean.
Cautiously bearish lean. This stock's just off of 52-week lows, having a nice day today ahead of that report on a relief rally here in the markets. All right, great stuff as always, Megan. Appreciate it.
Thanks for having me, guys.
All right, that's Megan Brantley, Vice President of Research at LikeFolio, breaking down the data. Kevin.